Hello and welcome everyone. Today's video is about bonds. What are bonds? Bonds are a type of debt security that are issued by companies, municipalities, and governments to raise capital. They are a popular investment option for people looking to diversify their portfolio and generate a steady stream of income through interest payments. In this video, we'll be discussing the basics of bonds, how they work, the different types of bonds available, the risks and rewards of investing in bonds, and how to include bonds in your investment portfolio. Basics of bonds. When a company or government issues a bond, it is essentially borrowing money from the bondholder. The bondholder is lending the issuer money in exchange for periodic interest payments and the return of the principal at a future date, known as the maturity date. The interest rate, or coupon rate, is set at the time the bond is issued and remains fixed throughout the life of the bond. Bonds are rated by credit rating agencies such as Moody's and Standard & Poor's, which provide an assessment of the issuer's creditworthiness. A high credit rating indicates a lower risk of default, and therefore, a lower interest rate. On the other hand, a lower credit rating means a higher risk of default, and therefore, a higher interest rate to compensate for the added risk. It's important to consider the credit rating of the issuer when investing in bonds, as default can result in the loss of principal and interest. Types of bonds. There are several types of bonds, including corporate bonds. These are issued by companies to raise capital for various purposes, such as expansion or debt refinancing. Corporate bonds can be further categorized by industry, maturity, and credit rating. Municipal bonds. These are issued by local governments and agencies, such as cities and schools, to finance public projects and services. Municipal bonds may be tax-exempt, which means the interest earned is not subject to federal income tax. However, it's important to note that municipal bonds may still be subject to state and local taxes, depending on the investor's tax situation. Treasury bonds. These are issued by the U.S. government and are considered to be the safest type of bond, as the risk of default is extremely low. Treasury bonds are issued in various maturities, from a few months to 30 years. High-yield bonds, also known as junk bonds, these are issued by companies with lower credit ratings and therefore, higher risk of default. As a result, they offer higher interest rates to compensate for the added risk. It's important to note that high-yield bonds are more speculative and carry a higher level of risk compared to other types of bonds. Investing in bonds. Bonds can be a good addition to a diversified investment portfolio, as they tend to be less volatile than stocks and can provide a steady stream of income through interest payments. However, it's important to carefully consider the creditworthiness of the issuer and the specific terms of the bond before investing. It's also important to consider the bond's maturity, as longer-term bonds may be more vulnerable to changes in interest rates. Another factor to consider when investing in bonds is inflation risk. If inflation increases, the purchasing power of the interest payments and principal may be eroded over time. Inflation-protected bonds, such as Treasury inflation-protected securities, TIPS, can help mitigate this risk by adjusting the interest rate and principal for inflation. Including bonds in your investment portfolio. When deciding how to allocate your investment portfolio, it's important to consider your investment goals and risk tolerance. Generally, investors who are closer to retirement or have a lower risk tolerance may choose to allocate a larger portion of their portfolio to bonds, as they provide a more stable and predictable stream of income compared to stocks. There are several ways to invest in bonds, including buying individual bonds or bond mutual funds or exchange-traded funds, ETFs. Buying individual bonds can be a good option for investors who want to select specific bonds and hold them until maturity, as this can help minimize trading costs and potentially maximize returns. However, buying individual bonds requires a certain level of knowledge and expertise, as well as a larger initial investment. Bond mutual funds and ETFs can be a good option for investors who want to diversify their bond holdings and have a smaller initial investment. These funds hold a diverse portfolio of bonds, which can help reduce risk and provide more stable returns. However, it's important to note that bond mutual funds and ETFs are subject to management fees and other expenses, which can impact returns. In conclusion, Bonds can be a useful tool for investors looking to diversify their portfolio and generate a steady stream of income. However, it's important to carefully consider the creditworthiness of the issuer, the terms of the bond, and the bond's maturity when investing in bonds. As with any investment, it's also important to regularly review your portfolio and make adjustments as needed to ensure it aligns with your investment goals and risk tolerance. Thank you for watching, and if you enjoy small-size finance education videos, consider subscribing. See you later.